Today, we're diving deep into the hidden world of IRS crypto enforcement. I'll show you what the IRS zeroes in on, why this first quarter is more critical than tax day itself, and how you can scrub your crypto footprint clean before any red flags turn into full-blown audits. Stick around, this could save you thousands. Hey everyone, welcome back to Numeratus, where we break down the real strategies for building wealth in the digital age without getting tripped up by taxes. If you're into crypto, you've probably heard the horror stories. Surprise IRS audits that drag on for months, penalties piling up, and that sinking feeling when you get the letter. Most people think the IRS only comes knocking after you file your taxes, but that's dead wrong. The truth is, the IRS spots high-risk crypto taxpayers way before you even submit your return. And right now, in Q1 of 2026, that's exactly when those audit triggers are bubbling to the surface for your 2025 activity. If you traded, staked, or even just held crypto last year, you might already be on the radar, and you wouldn't even know it. By the time we're done here, you'll walk away with a crystal clear understanding of the game the IRS is playing. We'll cover the secret math powering their crypto audits, the top red flags they're hunting for in 2026, the massive mistakes folks make right now in Q1, and actionable steps to fly under the radar this filing season. Think of this as your insider's guide to turning potential tax nightmares into smooth sailing. If you're serious about leveling up, whether it's cleaning up your crypto mess, slashing your audit risk, or just mastering wealth building as a modern entrepreneur, I'll point you towards the Numeratus ecosystem at the end. We've helped several clients navigate this exact chaos. Let's jump in and demystify how the IRS crypto audits really work. Let's start with the basics. But trust me, this isn't your grandma's tax talk. It's the gritty reality of how the IRS hunts in the crypto space. Forget random audits. The IRS doesn't play guessing games. They audit mathematically using cold, hard data to build your risk score. Here's how it all feeds in. First off, centralized exchanges like Coinbase, Kraken, and Gemini are now requiring to report your activity directly to the IRS, thanks to the Infrastructure, Investment, and Jobs Act, starting with 2025 transactions. They're sending Form 1099-DA for gross proceeds from sales and exchanges. That's right, not just fiat off-ramps, but crypto-to-crypto trades too. Stablecoin ecosystems? They're in the mix with reporting for sales above certain thresholds, like $10,000 aggregate for qualifying stablecoins under optional rules. Then there's blockchain analysis firms, companies like Chain Analysis that the IRS contracts with to trace wallet movements, DeFi interactions, and even cross-chain bridges. Add in reports from financial institutions monitoring your fiat on-ramps, NFT marketplaces flagging high-volume sales, and boom, the IRS has a full picture. All this data floods in during Q1. Exchanges must file 1099-DAs with the IRS by late January or early February and send you a copy by mid-February. While you're scrambling for your W-2s and 1099s, the IRS is reconciling everything. Your 2025 exchange trades, stablecoin inflows and outflows, wallet-to-wallet transfers, DeFi yields, staking rewards, NFT flips, and any patterns that scream something's off. This is their data reconciliation season, where algorithms crunch numbers to assign you a risk category. You have a high score? You're flagged for potential audit before you even file. Imagine this. You swapped ETH for Bitcoin on Coinbase last year. That's a taxable event, reported as gross proceeds. If your return doesn't match, that's a red flag. Or you bridged assets to a privacy chain like Monero. Not illegal, but if it looks like obfuscation, it pings their systems. Q1 is prime time because that's when the puzzle pieces come together. Now let's get real about what happens next. The stuff most YouTubers gloss over. Your audit risk doesn't kick off when you hit submit on TurboTax. It starts the seconds the IRS evaluates your crypto footprint against their data trove. And folks, this is where the tension builds. If there's a mismatch, you're in the crosshairs. Picture this scenario. You're a casual trader, but your wallets show high volume activity. The IRS sees it all. Here are specific 2026 red flags they're prioritizing based on their ramped up enforcement. Number 1, exchange reported gains that clash with your tax return. The IRS trusts the broker's data over yours every time. If Coinbase reports $50,000 in gross proceeds and you claim $20,000, expect an audit incoming. Number 2, large stablecoin flows like USDT or USDC without matching gains or explanations. Stablecoins aren't invisible anymore. Sales over certain thresholds get reported, and unexplained movements raise eyebrows. Number 3, unreported DeFi or staking income. Yields from liquidity pools, staking or farming? That's ordinary income, folks. Skip it, and their AI spots the gap. Number 4, NFT transactions lacking cost basis or showing wash sale patterns. Flipping NFTs? It looks like you're gaming losses. That's a trigger. Plus, some NFTs might hit collectible rates up to 28%. Number 5, sudden shifts to privacy-focused ecosystems. Again, legal, but it coincides with unreported gains. Algorithms flag it as suspicious. Number 6, high volume trading without claiming trader status. If you're day trading but filing as a hobbyist, the IRS might reclassify you. Number 7, claiming simple crypto activity when your on-chain data tells a different story. Are you oversimplifying? That's like waving a red flag. You might think, no, this doesn't apply to me, it's small. But the IRS systems don't care about vibes. They run on patterns and mismatches, and with AI matching tools now in play, even minor discrepancies can snowball. Crypto users will get hit with audits over forgotten staking rewards worth just a few $100. It's not about intent, it's about the data not lining up. Let's zoom in on why Q1 right now in early 2026 is the make or break window. Call it the IRS's matching season. Here's the timeline that most people miss. January, exchanges like Kraken send your 2025 activity reports to the IRS via 1099 DA for gross proceeds. February, stablecoin platforms and custodians pile on with flow data, and you get your copy by the 17th. March, their algorithms run full risk scoring, cross-referencing everything with blockchain traces. Before your tax pro even glances at your docs, your IRS profile is built, risk level, mismatch indicators, exposure markers. This is why audits often hit in summer or in the fall. They don't need your return to smell trouble. Your activity speaks for itself. Don't be the person that waits till April to fix things. The flags may already be up. Don't be that client. Here's where the conflict hits home. The IRS isn't out to get crypto hodlers just for existing. They're targeting the disorganized ones, the folks whose stories don't add up. Big difference. You don't get audited for making bank in crypto. You get hit because your reporting doesn't sync with their data. Most taxpayers I talk to fall into these traps. Let's break them down with real examples. Let's call this group number 1. I didn't know that counted as income. Staking rewards, liquidity pool yields, validator earnings, all taxable as ordinary income the moment you receive them. One client earned $5,000 in Ethereum staking, but thought it was free. No, the IRS sees this as ordinary income. Let's talk about group number 2. My records are kinda close enough. Close isn't good enough when the IRS has exact transaction logs. Mismatch cost basis on BTC sales? Instant flag. Let's talk about group number 3. My accountant hates crypto. If your CPA simplifies DeFi as miscellaneous income without details, you're inheriting the risk. I've seen audits start because pros didn't map wallets properly. Then we get to group number 4. I'll handle it next year. This is the most dangerous mindset. By filing time, your exposure is locked in. Procrastination turns minor issues into major penalties. The clash? Crypto's wild, decentralized nature versus the IRS's rigid, data-driven world. But ignoring it just amplifies the problem. All right, so here's the good news time. Most of these triggers are fixable before you file. You can flip your risk profile from high alert to all clear by getting proactive. Here's your step-by-step playbook. Number 1, reconstruct missing cost basis. Use tools like transaction histories or software to track original purchases. Number 2, map your wallets. create a narrative linking addresses to show clean flows, no mysteries. Number 3, correct gain-loss mismatches. Compare exchange reports to your records. Adjust for crypto to crypto taxes. Number 4, break down DeFi income. Report yields accurately as ordinary income. Document everything. Number 5, align staking and rewards. Value them at receipt time and include them on Schedule 1. Number 6, organize NFTs. Track their basis, sales, and avoid wash patterns. Note if collectible status applies. Number 7, document bridges and movements. Explain cross-chain activity to avoid suspicion. Number 8, build an IRS-ready compliance narrative, a simple document outlining your activity. It shows good faith. This synthesis of merging your crypto reality with IRS expectations removes flags pre-review. And that's what we do at Numeratus. We turn chaos into compliance. You don't need perfection, just accuracy and consistency. If this video has you thinking, whoa, I need to sort this out before I file, that's smart. Q1 is when it all surfaces, and the savvy ones acting now dodge the IRS drama later. You want to build wealth cleanly and confidently? Join the Numeratus community for resources and a network of like-minded entrepreneurs. The IRS algorithms are running as we speak. The question is, are you ready? Drop a comment below if this helped. Smash that like button, subscribe for more, and I'll see you in the next video. Stay compliant, stay wealthy. Enough said.